Welcome to Momentum Investing, property investing made easy. One of the world's top podcasts on property investing, bringing you the top experts in the field so you can learn firsthand what it takes to create passive income and take control over your financial future.
Hello, Momentum Investor, and welcome to the Momentum Investing Podcast. I am so excited for today's show because there's just so much that's going on with the property market right now. The overall economy with the corona pandemic caused the lockdown, and now the lockdown is opening up, and the lending went away, and now the lending's coming back, and there's just so much going on. Is the market going to go up? Is the market going to go down? What opportunities does this mean for the future? What risks are we looking at? There's just so much that's happening, and we need to start getting some clarity as to what we need to do as investors moving forward. So I asked my mortgage broker, one of the top mortgage brokers in the entire UK, Richard Ignatowicz, to come on this program and share what are the banks saying, what is the bank's analysis of what's going on, and what do they think will be happening in the future. So Richard, who's in contact with investors from all over, he's an investor himself and in contact with the banks, he has that unique position where he's seeing all these different factors come alive as we speak. And he's sharing that with you here in this episode. So this is going to be very, very powerful. You're going to have a lot of insights as to what are the risks right now? What do we need to avoid and be careful about right now as investors? And what are the opportunities going forward? And what's going on right now with lending. So he's got some exciting news for us. So stay tuned and let's get right into the interview. All right, welcome to Momentum Investing. We're so happy to have you here, and we are here with none other than Richard Ignatowicz. Thank you so much for joining us, and we're happy to have you here.
Thank you very much, David. It's always good to contribute.
Well, we'll see, right?
Yeah. Well, causing trouble from day one.
Always. So we're so excited to have you because we've had a lot of investors here on the show. We've had a lot of experienced teachers on the show who talk about, how to raise finance and, the opportunities they see. But what I feel is so exciting about this is because of your role as a mortgage broker, you have the inside look on what the banks are doing and what they're thinking and what their prognosis, which is obviously very powerful. They obviously have a lot of money to put into their due diligence on the market. So what do you see as the future? Like what's going to happen going forward? What do you see as potential opportunities, but also potential risks that we want to make sure we're safe from?
Yeah, very good question, Dave. The thing at the moment is that the lenders, as probably everybody knows, have been very cautious particularly in the UK with the lockdown. We've not had valuers able to go out, so a number of lenders have done what's called automated or desktop valuations. But what's happened there is that they have reduced their lending typically to around about 60-65% loan to value. Right now, as we speak, the opportunities for international investors, literally in the last day or so, has changed in that the lenders are looking at 75% loan to value, which is typically the norm. Okay.
And what's important is that, of course, that's the situation now that we're recording. Obviously, this is published in about a week after, so more will have happened. But so you're seeing the lenders are kind of slowly coming back to the old 75% level?
Yes, I would say the vast majority are looking that way. They are cautious. They have started to, in some respects, price in what we call risk to the new launches. So as a generalization, rates are a little bit more expensive than previously, maybe on average 0.25% more. So again, for the typical investors that'll be looking at properties around about 80 to 100,000, let's say, will not really see much of an impact. So right now, as we speak, our preferred lender for non-UK residents, they have changed their lending to 75%. The rates are in the region of about 4.1, 4.2%, whether you go for a 2-year or a 5-year fixed. Typically, the they're looking at 75% minimum valuation. However, the general consensus is that property prices may be dropping anywhere between 5 and 20%. I think maybe the 20% is over cautious, but they do view that certain geographical areas, what they would call hotspots, that may have been adversely or will be adversely affected by redundancies, such as, for example, in the south, where we wouldn't really recommend investing. Gatwick Airport has been affected by, for example, Virgin pulling out totally, British Airways making redundancies, Ryanair, etc. And consequently, those areas are likely to be hit more than others, but that will be duplicated in hotspots around the UK. So that's a very important factor to also bear in mind with anybody doing their own due diligence.
Right. So what do you see as an investor? Obviously, we see this as an opportunity. So what would you see, like which areas would be in that sense exciting, or which would you say are dangerous going forward and you should be careful with?
Yeah, I think is being cautious at the moment and not knowing how things are going to pan out. I think personally there will be opportunities to be had. I would hold back a little bit just to see how the dust settles. You know, we're not fully out of the lockdown. There is talk, unfortunately, that there will be more redundancies coming post-lockdown, that companies have not been able to survive. They've all had their staff furloughed, so they've had various government subsidies and financial assistance. So none of us really know how this is going to play out as things start to go back to some form of normality. A lot of the subsidies for businesses are going to finish about October time. And that's really when I think crunch time will come. Nobody knows whether there'll be another resurgence of coronavirus. They're talking of it being coupled with flu. So my general suggestion would be carry on with momentum, doing the various courses, doing the due diligence, getting things set up, but don't necessarily jump in with both feet unless they do come across some really good cracking deals that may be already available, maybe speculating 20% discounts, but otherwise to bide the time, because I feel that there will be bargains down the road.
Yeah, and of course, those who are selling now kind of know that this is the situation, and you
Yes.
know, obviously, a lot of them are distressed sellers. So it's
Correct.
it's that classic like, don't buy now, except when it's
Correct. Yeah. If something falls on your lap that's a great deal today, don't ignore it.
Yeah,
Okay,
exactly.
but I think there's this potential buyer's remorse where you might buy something and maybe at 5 to 10% discount, and you're happy with that. And then by the time you're coming to complete 2 or 3 months later, you know, the market's dropped another 10% or whatever. And then you're thinking of backtracking or renegotiating or whatever. And there's all the complications that come with that.
Yeah, obviously. And if we take it another step kind of and look at it over the longer term, you know, obviously with the way the market is shifting, and obviously as we've talked about before, a lot of companies are looking at, you know, how they're running their business, how their strategies are going to be formed, and what they're going to be doing going forward. What do you see that might bring as like future opportunities for us as investors?
Yeah, good question. And obviously, a little bit of crystal ball gazing, but it's good to see or try and predict how markets may move under the current changes that are arising and try and capitalize on that. Okay. My belief is that, particularly in the, let's say, secondary cities, whether it's Birmingham or Manchester or Leeds or Liverpool, etc., there will be companies, small, medium-sized, that will definitely be looking at downsizing their what we call commercial footprint. There may be small offices that will be vacated and very difficult to fill, and consequently great opportunity for under permitted development regulations to do office to residential conversions, which could mean JVs maybe with local UK funders or investors, and doing something along those lines. I did one the other year, which was converting a mill into 22 apartments. That size is quite large, but anything maybe 6, 10, 12, apartments in a building is going to be probably manageable as long as the JV partners can demonstrate some form of track record or experience in that arena, because there will be a requirement for development funding, and the developers do want to see ideally some form of track record. But definitely that area will be very much an opportunity of the future. I've no doubt about it.
That's awesome. Yeah. And what I like about talking to you too is the fact that you actually are an investor yourself. So you can say, you know, I've done this type of deal, and you kind of know what that means in practice. Can I ask, just to go completely separate track a little bit, how do you see that it has affected you as a mortgage broker to actually be an investor as well?
I think, without trying to sound too clever, it's given me the insight to then give guidance to other investors when they come to me with potential projects for review, is that most brokers, and I'm not being negative about this, they're just there to get you a deal, and they have no experience, so they don't know whether the deal is good or bad because of lack of personal experience. So I like to say I do the walk and the talk, so therefore I can also share that knowledge and expertise with my clients to hopefully give them guidance as to the, in my view, the profitability or the suitability of a project. Because also I've got the benefit of being here in the UK, and with my own experiences, I can see what maybe somebody, particularly without the experience, can't see. They're just looking at a spreadsheet. The numbers all look great and wonderful, but there's more to making a decision on a project than just solely numbers. Yes, it's an important factor, but there are other factors into play that, again, having the let's say, call it the on-ground knowledge and experience can make a big difference.
Absolutely. And I think that's one thing that especially a lot of new investors miss is a lot is actually going on in the terms of a mortgage, with the review policies and with the, just the way the structures are with the exits and things. So what would you say is important for an investor to kind of keep an eye out for when taking a mortgage? What are kind of those fine print things that a lot of people might miss?
To be fair, the main issue is, particularly when you're building a portfolio, the lenders want to see the cash flow situation and basically the sustainability of the overall portfolio. So just to slightly emphasize that, now that when we went into coronavirus, the government allowed landlords to have what we call mortgage payment holidays. And an awful lot of landlords, they jumped in for this financial assistance from day one, which then the lenders, after this, having realised there was this flood of requests, have realised that there was a lot of vulnerable landlords who couldn't survive just after 1 or 2 weeks into coronavirus lockdown, that they needed financial help. So going forwards, a lot of those landlords will find that they will not be getting funding in the future. So that's just an aside. I'm not sort of too worried about any small print or conditions in mortgage contracts. The main one to look out for is on when people are progressing onto commercial funding. There is a clause called a loan to value covenant clause, mostly in commercial lending, not your standard buy-to-let lending, that if property prices drop, so for example, when we had the property price crash in 2008 and prices went down 20, even some places 40%, the lender's insisting on maintaining a minimum 25% equity. So if, for argument's sake, prices went down 25%, the lender would go back to you and say, there is no equity left in the deal, we want 25% from you, and you've got 28 days. And in most cases, unfortunately, the landlords didn't have that, and the lenders were forced to repossess. And I know of lots of landlords who had never ever missed a mortgage payment in their lives, needed to find these funds. They couldn't, and they lost their portfolios. So that, I would say, is probably the one of the most extreme worrying and ones to look out for. But that's more so in commercial lending as opposed to standard buy-to-let lending. Otherwise, just make the payments and you're fine.
Yeah, because that becomes an interesting question, because in a lot of countries, obviously in the 2008, 2009 crash, it didn't matter if you were on a commercial loan or a regular loan. If you were underwater, so to speak, with no
Yes.
equity left, you could get repossessed either way. So what you're saying is in the UK, if you're on a regular standard buy-to-let mortgage, as long as you're making your payments, they won't go in and review your values?
That is correct. The however to that is that if, let's say...
There's always a however, isn't there?
Yeah. No, that's the main thing, that they won't come in and take the property. That's the main issue. But let's assume maybe 6 months later, you're looking to buy another property because you've got a bargain.
Yeah.
And you are... let's say what we call a portfolio lender, where the lenders will look at you with more of a fine-tooth comb, be more analytical, and they look at your overall portfolio. And whereas initially you were at 75% loan-to-value gearing, and now let's say you're at 85% loan-to-value gearing, okay, the likelihood is they will not advance you the money.
Right. So they would say, okay, you can buy this new deal, but for that you have to put in another 10% on your portfolio as well.
Correct.
To compensate for the move, which
Correct.
does make sense. That
Yeah.
you have to respect, and at the same time though, and that's an important factor, especially in these times when people are worried about what's going to happen with the pricing, is to understand that difference between what a commercial mortgage is and kind of a standard buy-to-let mortgage is.
Yeah.
You know, there are benefits to commercial mortgages, but there's also risk. Now we've obviously
Correct.
just shared the risk. What would you say is the benefit of a commercial mortgage?
Well, the commercials really are more, in my view, when you're advancing in your let's say property career, or I call it the ladder, the stepping stones. And what you're going to get, let's say you might buy a shop with a flat above, you can only get that on what we'd call a semi-commercial type loan. So a standard buy-to-let, you will not be able to get funding. So the advantage with buy-to-let mortgages as you're starting is your traditional terraced house to up to down. You can get reasonable rates. When you get into commercial, it's more expensive. However, the valuation is based upon the rental of the property and the yield for a particular area. So in actuality, you can get higher valuations. Okay, particularly if you bought maybe somewhere that's more run down, you then do any refurb, you add value, you can refinance out once it's tenanted, and hopefully try and get as much money out as possible. Okay, if you're dealing with HMOs, I did one where I bought a small office building, converted it into a 9-bed HMO. And because of the rental yield on that property, I was able to enhance the value quite substantially, get as much money out as possible, and allow me to use those funds to purchase the next project. Okay, so those are the more advantageous situations. The slight drawback comes in that you might be paying 5.5% or 6% on your funding, but then there's an offset against that.
Yeah. Well, that's a strategic move, isn't it? And just to make sure everyone kind of understands what you're saying there in the lingo, is what's exciting. Well, no, but it's interesting because it's like the commercial lending is not necessarily based on the actual value of the building if you sold it. It's based on the value of the rents, which means these like higher yielding strategies like your service apartments, your commercial, or your HMOs, your valuation can kind of go through the roof.
Yes.
And as you say, you can pull a lot of money out. Obviously, the interest rate might be a little higher, but if it is a high yielding strategy, that will work. And if you can pull almost or even all your money out of the deal, essentially you have a free property, which is pretty amazing.
Yeah, or whatever is left in, you've got a very, very good return on your capital that's left in. Alternatively, what some investors do is they may buy, for example, a rundown property to start with, and then sell it on or flip it. Okay, they've increased the money that they've got to work with as working capital. They do it to maybe a second time or a third time, and it might be that every fourth property they retain, and then they go and do it again. Another three, build up the capital, and then the fourth one they retain.
Yeah, I mean, there's so many fun ways we can do.
Yeah, absolutely.
And one thing I'm thinking though is a question we often get, and that I would love for you to address, kind of once and for all, right?
Okay.
What is the we're looking at right now, like the buy-to-let mortgage versus the commercial mortgage. But a lot of people come in and like, well, if I'm buying a portfolios, for example, a buy-to-let portfolio, or as you say, when you're starting to build up a buy-to-let portfolio one by one, where does that fall in these two camps?
It's more likely to fit into the normal standard buy-to-let because the portfolio is likely to be a combination of 5, 10, 15, 20 single individual household properties.
Yeah. And
So
would that be still a mortgage on the portfolio then, or would it be individual mortgages for each?
The lender will do, however, let's say there's 10 properties, they'll do 10 valuations based on typically bricks and mortar. The only possible exception to that might be, as one of my clients has just sold a portfolio of HMOs.
Right.
So basically that was then, although they're each individually valued, they were done on a commercial basis because typically the HMOs tick the boxes that justified a commercial valuation. So usually it's not easily or readily convertible back to a normal buy-to-let or a home. So they might have en suites in all the rooms, or they could be some bedrooms or more, which makes it a sui generis, again, which needs planning permission, or in my case, it was an office building, which wouldn't be valued under a normal buy-to-let. It would automatically have to be valued on a commercial basis anyway.
Right.
Okay. So it depends on the makeup.
Yeah, of course. But that's interesting to know. And so, for example, if you have a portfolio of buy-to-lets, then you could easily sell them one at a time. You wouldn't have to, sell the whole portfolio.
Correct. The other issue is with portfolio, depending which side of the fence you're on. If you're selling, let's say, 10 single buy-to-lets together, the issue is that the buyer will always want what we basically call a discount for the fact they're buying 10 properties.
Well,
okay?
Of course, it's if you go to if you go to Walmart instead of,
Correct.
You're expecting to get a group discount. Buy two, get one free.
Absolutely. Well, yeah. So in our case, when we sold the mill conversion, where we had 22 apartments, we would have maximized the sale or the gross development value by selling to 22 individual people. But as it happened, an investment pension scheme came along and they wanted the whole building. So we were happy to then sell it in one go. Yes, they did want a 10% discount. Okay. But then the alternative was that we may have had to wait 6 or 9 or 12 months by the time 22 were sold. And for the first roughly 18, we'd have to be paying back the development funder because they had the first call on any sales until their funds were paid off. So our profit was typically about in the last 4, and therefore it might have been 12 months before we got our money.
And even there, you're obviously paying development finance costs during the process.
Correct.
And obviously, since it's 22 transactions instead of 1, you got higher legal fees and everything else. So
yeah,
absolutely. And that's where it comes in, the strategic part. And that's why we love having you, who's actually an investor as well, who can sit with us and kind of go like, well, yes, this mortgage is cheaper, but if you want to refinance again, or if you want to do this, or if you want to do that, then you have that ability to help us and support us in that.
Sure.
Which is very, very valuable. So what are you seeing now among investors? Obviously, you're tapped into the banks. You're also tapped into the investors. What's going on over there now in people's minds?
Yeah, I think we've got two sort of clashes of ideals. I would call it the more mature investors who've been in the business for a while, are looking forward to effectively what they would view as future bargains. Okay. Then the other side of the coin is that you've got a positivity in the marketplace as well, whereby people are saying, well, we've been locked down for 2 or 3 months. Life is too short. We want to now maybe remortgage or get some finance, not necessarily just to also buy maybe another buy-to-let property, but we really deserve a round-the-world cruise or a special holiday, because this lockdown has gelled our minds and thought processes. On the other side of the coin, you may get people who are more cautious say, "Oh my God, this is a major tragedy, and we've got to, we can't even go out and socialise even after a few months. We've still got to keep social distancing. What if I catch it on the second wave, etc." So there's this whole mixture, a melting pot of ideas, and which will be more prevalent or whatever, only time will tell. It might be that only 5 or 10% of the population is still going to be very cautious after the lockdown. It might be 55%, etc. So this is what I'm saying, that there's this expectation in various camps, but I think, as I said earlier, it's probably best to wait, see how the dust settles and start to see how things are actually developing, because we can speculate all day long. But I think in the next 3 to 6 months, we'll start to get a feel for actual how things are going in the marketplace. And I think the third probably category that is the most worrying is how the economy will come out of this, and therefore potential redundancies. So those people will unfortunately be losing homes, but on the other side of the fence, there'll be people who'll be buying those homes.
Exactly.
Etc. But that's not going to be immediate.
Yeah. No, and that's one of the, I guess you can kind of say, I think there's two camps there on like the government support. Obviously, a lot of business people love the government support because we get money. The other side is, of course, is that all they're doing is they're delaying the inevitable crash.
Potentially, yeah.
So there's kind of two camps to it. So it'll be interesting to see kind of who gets the right of it in the end.
Yeah.
And of course,
it's a wait and see situation, in my view, anyway.
Yeah. And of course, I can imagine right now there's a lot of 18-year-olds who would kill to move out of their homes right now.
Yeah, and the parents want them out.
Exactly. Can you imagine?
Yeah, so there's that, let's call it pent-up demand, or, not even 18, any young generation that's been at home, so they want to, even if they go and buy a place with some of their friends or their girlfriend or whatever, just to get their own independence. So there may very well be a big pent-up demand for first-time buyer properties and mortgages. That might put competition with investors who will be typically looking to house that type of a person as well. So again, it's all going to be sort of evolving from those sort of demands.
It's going to be very interesting, and I think as long as you keep your kind of your finger on the pulse, I think we're going to be able to see these opportunities, as you talked about, the office to residential kind of conversion. That is probably going to be an opportunity as so many companies are kind of already starting to think, seeing like increased productivity from working from home. And
correct.
So there might be a time now that we never go back to the office again.
Yeah, or it might be that it's done on a rotation basis or equivalent, because they'll still want you to come into the office. It might be 1 or 2 days a week.
Yeah, exactly.
Just to maintain that.
Your meetups and like let's make sure the team stays connected. But
correct. Yeah. So I think my view on this, because although I've got over 20 years experience in the industry, I have no experience of a coronavirus global lockdown.
Well, no one since the Spanish plague has had anything to do with a plague to do. So it's definitely new territory for all of us.
Yeah, so I think we've got to let it play out. So a lot of people get frustrated when they call me or maybe listen to this podcast. Think we can wave a magic wand and say, this is definitely going to happen. That's why I keep saying, let's see how it plays out. And likewise, whether via podcasts like this or on the Momentum Facebook groups and so on, it's very good for people to stay in contact on a regular basis to be gathering that knowledge to give them the confidence to then make a decision when they do.
Yeah, and I appreciate you saying that. And obviously, we appreciate that you're active in that group and people can ask you questions when they have. What I think we have done, though, and I think that's important to reiterate to everyone listening, is that there are certain factors that will be playing in. As you say, we can't wave a wand around and say, like, this is what's going to happen. But it's kind of the factors that we see are, well, probably there's going to be redundancy, which will reduce demand of purchasing and increase supply. At the same time, you have the first-time buyers that might have a pent-up demand and might come into the market. You have investors who are actually, a lot of investors are really excited now.
Correct.
And especially those who kind of were a part of the 2008, 2009 and maybe missed the boat a little bit, maybe got in late or got caught in that, or it's like, it's time to come back and win this time. And then it's stuff like the commercial, like conversions there, because companies will be changing. So there's so much that can affect an increased supply from old office buildings coming in, just like it was with pubs a few years ago with the big pub conversion. And then of course the pent up buying interest, but also the fear of getting into the market and increased redundancy. So there's pressures to push the market prices up, but there's at least as much pressure to push it down. So it'll be interesting to see which way it goes.
Exactly. Yeah.
Awesome. Do you have anything like parting words you would like to share, your wisdom to share with the audience before you leave?
Now you're putting me on the spot. I'm just going to say right now, don't jump in with both feet. As I keep saying, analyze the marketplace, see how it's going, and waiting a little bit longer will probably pay dividends because you have more clarity how things are going.
Yeah, awesome. That sounds great. And so obviously for everyone, Richard is in the Facebook group and International Property Investors, so you can connect with him there. But also, how could they connect with you if they want to, ask questions or get a mortgage? How do they get a hold of you?
Sure. Thank you for that. They can contact me by email, richard@mortgagesavers.co.uk. I'm on Skype, which is Ricky on Skype. So it's dead easy. I've already been in contact with quite a lot of the group. As you know, I've been to Sweden about 3 or 4 times last year. I made contact with an awful lot of investors. So I'm now sort of talking to those on a regular basis. So quite happy to analyse deals, chat things through, and just sort of be a bouncing board. So look forward to hearing from anybody and everybody.
That's great. And if you didn't catch that, that's Ricky on Skype is the Skype. Richard@mortgagesavers.co.uk, or just hang out in International Property Investors and you'll find Richard there. And pretty much if anyone asks that question, I tend to tag Richard in the post if you have a question about mortgages, because he's our king when it comes to mortgages and getting us the best deals. So that's our resource right there.
Thank you, Daniel.
All right. Well, thank you so much, everyone, for listening. Thank you so much for joining us, Richard, and I'll see everyone on the next episode.
Thank you.
Thank you so much for joining us today for the Momentum Investing podcast. I hope you see what's going on in the market, the opportunities that are there, and also how you need to start structuring your portfolio to be able to move forward. Our next episode is really, really exciting. We have Justin Whittemore, who's coming on, and he is probably the best finance raiser I've ever met. The man is brilliant when it comes to raising finance. And what he does in this episode is he shares step by step how he raises millions of pounds. I mean, just in the Corona pandemic period alone, he raised over 850,000 pounds from new investors, not his current investors, but new investors just in that period. You're going to learn exactly his step-by-step process to how you can raise that amount of money in a short amount of time. It is very, very powerful. So stay with us for next week when Justin shares that. I also have some very excited news. You probably notice how excited I am at this point. We are now finally launching what I think is the best thing we've ever come out with in Momentum Property Education. We've created a webinar called the 3 Simple Steps to Property Investing, where we show you our framework for how to invest in property, how you can go from where you are now to build a successful property portfolio in 3 simple steps. We'll show you how to do it, and we'll show you the 3 most common mistakes new investors make and how to avoid them. So how you can reach your goals as safely, as quickly as possible. And best of all, it's completely free. So in the show notes, I've added a link. You can go to join.momentumpropertyeducation.com or just click the link in the show notes and you'll see that you can register for the webinar. It is incredibly powerful. We're very proud of it. So please make sure you register, you sign up, and make sure you stay tuned for next week's show with Justin so that you learn the secrets to raising all the finance you could ever need.